Well, welcome everyone to the Bell Asset Management webinar. What can global equity investors expect in the year ahead? Matt, if we can move to the disclaimer page, please, that'd be great. Thank you very much, everyone. Please take time to read this. It's very important information. My name is James Biggins and I'm a sales director here at Channel Capital. We are the distribution partner for Bell Asset Management. Bell Asset Management, as you know, are a global equities manager based here in Melbourne with two investment strategies available for investors, which is the Bell Global Equities Fund and the Bell Global Emerging Companies Fund. Today, I'm joined by Ned Bell, CIO of Bell Asset Management. And Ned's going to provide his perspectives on a couple of key themes, which will, influencing global markets and, impacts for the years of 2022. We're solely going to be focusing on a few different areas today, which is around global monetary policy, the economic cycle rotation, company earnings, and responsible investing, which is starting to get more and more traction. We'll also be focusing on, as I said before, the years or next year as well, and look back at the lessons learned from this year. A brief background on Ned. I know most of you have seen me and Ned do this webinar, I think 5 times this year, but I'll just quickly gloss over it. Ned's very impressive, but Ned has over 20 years of experience in the investment management industry and is primarily responsible for the overall outcomes of client portfolios and providing investment leadership to the Bell Asset Management Group. In terms of, one of the portfolios, which is the small mid-cap fund, we do see some really strong reasons why to kind of own it. And some high-level reasons are the strong potential growth for opportunity, and Ned's been able to manage a really strong portfolio this year. We also see less valuation risk than other asset classes that are focused on growth, and also for diversification, which clients always need. I think also when you look at adding the way that Bell define the mid-cap universe, it's quite interesting. We have a minimum market cap size of 1 billion, a return on equity of 15% or greater for 3 consecutive years, a quality score, and then a fundamental and quality test. And with that, you get a solution that has delivered strong long-term returns with a low risk profile. Today, the webinar is going to be running to 1:15, and please submit your questions with the Q&A box down below. Well, Ned, good afternoon.
Good afternoon.
To the last one of the year, so I'm really looking forward to today. But I thought while we might focus on the macro, and specifically we've got a chart up here for everyone to look at, but there's been 2 big themes in the markets and coming into 2022. I guess the first big theme to focus on today would be global GDP. And can you share what markets are focused on and the forecasts for GDP growth next year?
Sure. So welcome everyone. Thanks for joining. So I think this is very important because I think with the view in terms of the global macro recovery is probably starting to change a little bit from where it was even 3 months ago. So I think 3 months ago, the consensus view was we were still in the midst of this fairly unimpinged global economic recovery, and it was going to drag on or going to keep pushing out into next year. I think the view's probably changed or starting to change a little bit, and it's really, frankly, coming from China. And the fact that, it's obviously no secret that China's GDP growth has been a huge contributing factor to the global economy in the last, particularly the last 5 years. But one of the outcomes, or one of the outcomes of what's happening in the property market in China as we speak, is that as that sort of growth rate starts to moderate, it will eventually filter through to the global GDP growth more generally. And if you think about the scale of the property market, and I'm not so much talking about Evergrande or the companies in particular and the financial issues themselves, it's more about the issue of to what extent does that depress global GDP growth? To what extent does that have an impact on Europe, US, et cetera, et cetera? And I think if you look at this table, like global GDP growth, clearly, big contraction last year as a result of COVID, big bounce, 5.9% growth this year. And then next year, the consensus view is more of a moderation. Still very strong growth, 4.5%, and that's arguably what's been priced in. But again, to some degree, that's predicated on a pretty robust economic outcome coming from China of say around, and again, these are consensus numbers, around 5.5% growth for next year. the issue from my perspective is that if you look at the most recent global GDP, the most recent Chinese GDP print, it was 4.9%, down from 7.9% the previous quarter. That's a big drop. That's pretty meaningful. And I think, again, when you think about the idea that property investment represents 30% of GDP, it's a big part of the Chinese economy. As a reference point, if you think about the housing market and property market in the US, pre the GFC, it was about 18% at a time.
Right. Okay.
So it's not insignificant. And I sort of tend to think that there's a little bit of a risk that that 4.5% number globally could come in a little bit lower than what people are expecting, notwithstanding the fact that we still have pretty much every government around the world trying to inflate our way out of the COVID, the COVID sort of recession that we saw last year. So I think that's particularly tough. I still think that's got a way to play out. On the benefit side, I think, pleasingly, what we have seen is consumer spending has been really robust this year, and particularly in the US, where the consumer effectively represents 70% of the economy. And that rebound that we'd expected has absolutely playing out. And I think to some degree, the various supply chain disruptions we've seen essentially has the effect of just pushing some of that growth into next year. So I think that's actually not such a bad thing. You're effectively just elongating or prolonging that sort of recovery somewhat. So there's a few puts and takes there.
Okay. And I see here on the one of the other big theme is obviously inflation. And then, do you see that being, I guess the word being transitionary as everyone's kind of throwing around, or we start, like you were saying, potentially into next year or the start of next year as well? Yeah,
it's a good question. And Powell was using the word transitory, pretty, with great effect a couple of months ago, but it seems to have disappeared from the vocab more recently. And I think the way we think about it is that you've got obviously much higher oil prices, you've got commodity inflation, that's obviously causing some issues, and remains to be seen how long that will be an issue. But I think on the other side of the coin is you've got wage inflation, and the wage inflation is, and this is not a huge surprise to us, is becoming more and more of an issue. And so we feel like that is going to be with us for some time. There is one of the most common things we keep hearing from companies is that, staff availability is a real problem. One of the side effects of COVID is you've got a lot of people who simply don't want to go back to work. They're rethinking their lives and their willingness to work, and that's causing some real, labour constraints, and that's across multiple geographies, multiple industries. So I think that wage inflation is going to be with us for a while. And so when you put all of that together, there is a bit of an argument that the central bankers have got a slightly difficult situation, in that you might have a situation where GDP growth starts to moderate somewhat at the same time when inflation is spiking, which is not a great situation per se. So, so I think inflation is going to be with us for some time is the short answer. And
then I guess further to that, under that scenario, what kind of strategies do you think kind of, tend to perform well, or, what to look for in what sectors and things like that?
So I think some of the semi-obvious ones, clearly things like energy has been that's been the best performing sector this year. So some of the actual causes, if you like, of inflation are obviously good places to be. And then, but I think, when we think about I guess from a style perspective, we would, and this is going to sound very biased, but obviously quality companies who've got pricing power, and they don't have and they can pass on those commodity increases. Those are the ones that are going to benefit over and above the ones that can't. So generally, lower margin junk type businesses are the ones that are going to really struggle. I think some of you've seen a little bit of the consumer staples companies. They're starting to sort of feel the effects of that through things like packaging, but also food prices ticking higher. But generally, the other point I'd make is that the services businesses, so whether it's a software company or consulting businesses, clearly they don't have any input price pressure. So clearly those types of businesses and the less capital intensive businesses tend to do better during inflationary periods. But and then the other point I'd make is that, I mean, obviously as inflation goes higher, obviously goes in tandem with interest rate expectations going higher. That tends to be, signs of trouble for the most expensive stocks in the market, because as night follows day, interest rates go up, high PE stocks come down.
Yep.
We're seeing that now, and that is starting to sort of have an effect and arguably trigger a bit more of a rotation out of the most crowded growth names into effectively the rest of the market. And it's not quite as binary as sell the highest growth stocks, buy the cheapest, junkiest companies. It's more about just more diversification.
And adding that in. And then I guess we're in this scenario, just we looked at the positives and quality kind of being a good place to play.
Yeah.
Where can you see things kind of doing poorly, or where maybe either from a style or even from a region point of view? Like, where would you say that, inflation is going to probably hurt?
Yeah. So I think I'd say a couple of things. I mean, clearly emerging markets is something that you've got to think about, and the nature of emerging markets has changed quite dramatically in the last, particularly in the last 10 years, where 10 years ago you had energy as being a huge proportion, energy and raw materials being a huge proportion of that index. That's dissipated dramatically. It's not just Brazilian and Russian oil companies now. Now it's Tencent and Ali, and the emerging markets index increasingly looks like the Nasdaq, frankly, from a sector perspective. So as much as you could have made an argument that emerging markets would be natural beneficiaries, it's just the impact has been dissipated so much. So I think, and then obviously when you've got this deceleration in growth in China, that in particular, because China is obviously a huge part of the EM puzzle, that is obviously not great for earnings amongst EM. And, that has arguably got a ways to play out, because it's not going to be just contained to a handful of property developers. It'll spread through the banking sector, suppliers, all the rest of it. So I think the earnings risk in EM is quite meaningful. And then you've obviously got the regulatory issues over and above that. So I think that's one part. I think the other point is that if you think about, let's call it the deep value part of developed markets, many of those companies have, and these are like, very cyclical industrials, the banks. I mean, a lot of those companies have had these huge rebounds, like massive rebounds off the COVID lows, and they were arguably pricing in a Goldilocks scenario. And I would suggest that, based on what we've been talking about, they have maybe got out over their skis a little bit. They're probably pricing an unrealistically positive outcome. And so there's a bit of risk there, I think, in some of those deep cyclical and the industrials. And so I think those would be the main points I'd draw to. Okay, cool. Yeah.
Well, we might we've got the outlook up here.
Yep.
It'd be great if you could just walk through, let's see where we kind of touched on this last webinar, but we didn't really go into much detail. So we're good to kind of go through the earnings rebound and kind of, the EPS earnings would be really interesting.
Yeah, sure. So I think this slide really, everything I've said sounds pretty negative, but I think when you come back to earnings, and that's what's really going to drive markets. And there's a lot of other factors that drive those earnings. So in this top table here, what we're looking at where, and again, this table shows just the MSCI World Index consensus numbers. And the numbers to draw your attention to is looking at the 2021 EPS number versus 2019. And the point we would make is that it is like, in other words, this year's earnings, they're 37% higher than pre-COVID levels. Everyone knows last year was a disaster, so just ignore that. But the point is that earnings have had this amazing recovery, but the market hasn't necessarily kept up. So the MSCI World Index is about 30% higher than the pre-COVID levels of, say, Feb last year, but earnings are 37% higher. So I think that's still being missed, and that still keeps us very optimistic. And then when you drill down into the small mid-cap names and you actually look forward to next year, you've got the 2022 EPS numbers, borderline 70% higher.
Right.
So this earnings recovery is quite extraordinary. But again, the small mid-cap index is only 30% above those same levels. So in the small mid-cap market, the disconnect between the earnings recovery and the price recovery is effectively, it's called 40%.
Yeah.
It's very meaningful.
Yeah.
And that is completely missed. And that represents to us a massive opportunity. And then the natural question is, okay, why? Like, why are these earnings recovering, so quickly? And it's several factors. I mean, number one, you've obviously got the revenue acceleration that's coming as a result of stimulus, the consumer getting back, government's trying to stimulate their economies. That sort of almost goes without saying. The second thing, which I don't think is that well understood, is that a lot of the temporary costs that were taken out of businesses or were considered temporary cost reductions up until 6 months ago probably become somewhat permanent.
Yep.
And so you've effectively got these businesses that are now running far more efficiently, almost running their businesses off the sniff of an oily rag. And then you overlay that with high revenue acceleration, and the earnings inflection is huge.
Yep.
And that is missed. That's I don't think that is very well understood by the market more generally, because many investors often don't look beyond the end of their own shoes when they're looking at actual earnings. But I think that has still got a long way to play out. And you look at the actual results, like Q1, Q2. I mean, the numbers that we held in our all-cap strategy, they're beating their numbers by 20%.
Yeah,
like the actual earnings and Q3, which is happening now. I mean, the actual earnings results are just extraordinary. They're doing incredibly well. And so I think and that's what it comes down to. At the end of the day, we're bottom-up stock pickers, and our focus needs to be on what are the companies doing, and they're doing really well. And you've really got this sense of the strong getting stronger. So that the stronger companies are just getting more market share, they're getting more efficient. There's more wallet share bleed away from the weaker companies towards the stronger ones, and that thematic feels like it's still kind of in the second inning of a baseball game. It's just got a long way to go.
Yeah, fantastic. Well, we might pivot to a different part of the discussion now, and just I know responsible investing is something that when you and I talk to investors, it keeps coming up.
Yep.
And I just thought it'd be good to kind of share with the audience today that maybe haven't heard about Bell's approach, just to kind of walk through, some examples that we've got up on the screen, but just your approach to ESG investing. Yeah,
sure. So it's something that, I mean, first of all, in thinking about our approach, first of all, we've been doing this for a long time. This isn't something that's new to us. We've been managing institutional mandates with ESG sensitive restrictions for, 10 years or more. So this is not new to us as much as it's become, a bigger topic of conversation. But the way I describe us is that we have it's a very pragmatic, integrated approach to ESG. It is not, we don't claim to be impact investors, because we're not. What we do is, and I think also by being a quality focused investor, that very closely aligns us with companies that have not only got very good ESG characteristics, but they don't need much encouragement to make proactive, put proactive things in place to improve their ESG outcomes. The same cannot be said for some parts of the market where they're just unwilling to to move the ball further down the track. So, and in terms of how we implement that, I think, again, very important, it's really implemented right through the process. So we screen out certain sectors, which we've done for a long time, and we're continually raising the bar on that. So you're screening out things like coal, tobacco, uranium, adult entertainment, weapons. We've recently added some revenue thresholds over and above that. So that's looking at, so for example, say in tobacco, you'll have some of the retailers themselves will have a certain proportion of their revenue coming from tobacco distribution. The same thing when you're looking at things like gambling, some companies have got a revenue contribution. So that's really just us lifting the bar, which we've always done. And I think the other point I'd make is that we take a very hard line on this. Like, if we can't get comfortable from an ESG perspective, we just will not invest in a company per se. We're not going to put a discount on it. It's just not going to get in. And I think, some of the names, at the top of that page, you can see Alibaba sort of raises a few eyebrows, but we've never invested in Ali because, amongst other things, their workplace culture is pretty poor. I mean, the 669 work culture is, looking at through the social prism of ESG, is pretty horrible.
Yep.
It's not very conducive to management having a good constructive relationship with their workforce.
Well, maybe explain what 6.6. Not some people might not know. Be good to.
So it basically it's prevalent throughout a lot of the Chinese tech companies, but it essentially means that there's essentially where management are encouraging employees to completely overwork themselves, and if they don't, they're not going to get anywhere in the company.
Yeah.
And that has all sorts of ramifications from a social perspective that that it's just not conducive to a healthy balance between the interests of the employees themselves. And then you look at some other names there, but Walmart. I mean, clearly, clearly they've always had a very combative relationship with their workforce, and I think from what we did, like particularly last year during COVID, where looking after your workforce was absolutely critical, and you either did the right thing or you didn't, and that was, and I think, thankfully a lot of our companies, because they're more quality bias, they don't need much encouragement. And if you look companies like Home Depot and Tractor Supply, for example, they really stepped up. Home Depot spent $800 million in additional benefits for their employees, so that they could take additional leave, they could stay at home, look after their family members who might have been sick, not have to come to work and spread COVID. But again, they took the decision to actually spend shareholders' money to do the right thing by their employees, and that's a huge tip of the hat. But it was a very binary approach. They did it or they didn't. The other, just a couple other points here I'd make, which I think surprised some people somewhat, but from a carbon perspective, the carbon footprints of our strategies are very, very low.
Okay.
But it's not just by avoiding oil companies, for example. So if we just flick to page 8, next one, yeah. Previous one, page 7, I've got the wrong slides. The bottom left there, you can see that the carbon risk, and this is the Bell Global Emerging Companies Fund.
Yep.
So it's 82% lower than the benchmark. Right. But again, like if you think about, some people might say, oh, well, that's just from screening out poor quality. It's actually not the case. Like energy only represents 3.7% of MSCI World, and 3.7% of the MSCI World SMID Index. So it plays a tiny part of that puzzle. It's more about us actively avoiding companies that have got huge carbon footprints, and gravitating towards companies that have either got low carbon footprints and they're doing what they can to actually alleviate their carbon footprint per se. So if you take a company like Thule, the Swedish company that's the manufacturer of roof boxes and bike carriers and all the rest of it. So they've, again, as a high quality business, they've made the decision, we're going to spend money to get basically carbon neutral. So they've actively gone and invested a lot of money to make sure that all of their power that they use through their facilities it's 100% renewable.
Yeah, right.
But again, you either do that or you don't. Yeah. And that's where I think, when you invest in quality companies that are generating free cash and they've got good margins, they've got the funds to actually do it. Yeah. Whereas if you're looking at other companies where, I always use the example of a company like Tyson Foods in the US, and thinking about Tyson, so big meat processing plants in the US, that the risk of staying in the office was a hotbed for COVID. That work environment, incredibly dangerous. Pre-COVID, you bring COVID into it and it becomes 10 times worse. They arguably had the opportunity to spend quite a lot of money to make their workplaces somewhat safer. They didn't really do it. Right. And partially because they didn't have the capital to do it. They didn't have the margin to do it.
Thin margin.
Yeah, exactly. So the point I'm trying to make is there is a very close correlation between high quality companies and good ESG outcomes. And for us, I think, ESG, like we were saying before, there's 25 people get 25 different interpretations of what ESG is. But I think from our perspective, it is about the outcomes, and you need to look at the outcomes and these, and when we look at our portfolios, the outcome of what we do from a bottom-up perspective is, these are the MSCI reports, and again, the SMID strategy, you can see it's a AA rated strategy. So the actual companies we're investing in are exceptional. They're very high quality companies, and it's no sort of coincidence that you happen to find them within that sort of universe of companies we ordinarily focus on.
Yeah, they're leaders. Yep.
Yeah, exactly.
And then I guess, with that, how do you engage with these companies? Like, I remember you've used an example offline before about, some companies don't really appreciate the metrics that they're producing, and how else do you engage with companies on these types of issues?
Yeah, so it's two things. If we just go back 2 pages to the, yep, that one. So I think, so on the engagement side, there's 2 things. So first of all, you're engaging with them collectively with other investors, obviously. So we're always doing that, and that's joining, whether that's, looking at, I mean, there's a whole bunch of things we do there. But I think on the direct engagement, from our perspective, what we do is we try to focus on what are the biggest ESG risks that are most prevalent to the company in question. And so when it comes to, like, say, a company like Hershey, or there's another company I've used in the past, there's a company called Givaudan, which is a Swiss company. It's the biggest manufacturer of natural vanilla actually in the world. The elephant in the room is child labour, right? So the question we've got is like, okay, how are you making sure that child labour doesn't get into your supply chain? And so I think, so from that perspective, like, to use that as an example, we spoke to them about this, what they do, which is quite amazing. This is a very specific, topic, but they, so Madagascar is actually where something like 98% of the natural vanilla in the world comes from. What they do is they go and invest, and they actually build schools in and around the farming communities from where they source their vanilla. Okay. And then they do audits to make sure the kids from the farms they're sourcing the vanilla from have been attending school. And if they don't, then they don't buy vanilla from those farmers. So that's a very proactive way of making sure that what is ordinarily a very big risk doesn't make its way into the supply chain. But again, like all these risks, they either get on the front foot and do something about it, or they don't. And so I think that tends to be how we tend to engage with the companies, is like, it's almost like prioritizing what are the biggest risks and then what are they doing about them to alleviate them. And the second point is that we also it's also about encouraging companies to just be more open and tell their story, be more open about telling their story from an ESG perspective. And that's particularly relevant in the small mid-cap space, where often the companies are actually doing a really good job, but they haven't been all that good about telling their story to MSCI or Sustainalytics or one of the research providers. And the classic example is Yeti, who, like, their first rating out of the block was a AA. Yeah, right. And so that's a great effort. It's a sign that, in terms of all their practices leading up to their first rating, it was actually very good. They just hadn't articulated very well. So I think we try to be very, and like we were saying before, you've got to encourage these companies too. If you come at it from being too combative with the companies and you're wagging your finger at them about certain issues, you're not necessarily going to get them to improve. But if you do it in a very collaborative way, that's, like, for example, more recently, we've just sent all of our investee companies our updated stewardship policy as a way of providing them with a framework of the things that we think are important, the SDGs we've aligned ourselves with. And that just encourages a really constructive debate and discussion around how they can actually improve.
Yeah, right. Yeah. Well, it's certainly, I guess, taking, focus of the companies as well.
Yeah, absolutely. Yeah.
Well, we've spent, I think, some really good time on the integration approach. Now we might talk to some positioning and trade activity for this year. So, I guess still sticking with that theme of ESG, but it'd be good to know. I see you've got Facebook up there, and it'd be good to kind of walk through why that's appeared on the sell side, and maybe link it back into the discussion we're just having on ESG as well.
Yeah, so I think some of those names on the sell side. So Couche-Tard, so that was an issue where it's actually the tobacco threshold. So they're a service station, convenience store retailer. Last year, tobacco started to creep above the 10% threshold, and that sort of started raising some alarms, and we ultimately decided to sell for that reason. Facebook, I mean, it's no secret they've had ESG issues for some time. It's not, I think so they've effectively been on watch for us for about 2 years. And what we've been basically looking for is them trying to lift their game and, respond well and productively and proactively to, frankly, the barrows of criticism, and some of which has, been pretty fair coming at them from the regulators in the US. I think we ultimately got to the point where we felt like they're just not doing enough, and what they're doing is probably it's more for show, less substance.
Yep.
And I think, like anything with AirShare, it's hard to make a judgment call on them at a particular point in time. It's looking at the progression. It's looking at how they change and to what extent they've got a willingness to improve. And I think we ultimately just got to the point where they're not really willing to, take on the criticism and make some hard decisions to sort of improve their outcomes. So that was really what ultimately got us out of the name. And I think, and their unwillingness to do that, to improve their game on that front, will ultimately, I think, have an impact on their earnings, because it just attracts more and more regulatory criticism that ain't going to go away anytime soon, frankly.
Yeah, right. And maybe any on the buy side, is there any stock that you'd like to go deeper on?
So I think on the buy side, so in the small mid cap portfolio, so again, there's the 5 names we've introduced in Q3, Q4. So GN and Intertech are small, more sort of in that small cap range.
Okay.
And sorry, Medicis too. So these are 3 names that we've watched. We've owned Intertech before, but these are names where they've always been in the camp of being a little bit too expensive. We've been waiting for some earnings uncertainty, volatility to give us the buying opportunity. That's exactly what's happened. So those 3 names have come off their highs. They've got down to our buy levels, and that's what's really triggered the buy there. EA, bit bigger company, but again, that's drifted more recently. Some been delays, but I think they're going to have a really good earnings year next year. And the Investors Win System is probably it's one of what I call sort of the picks and shovels ESG company. So leader of win technology, and again, that's been soft. We held back from buying that late last year when it looked like Biden was going to win, and all the picks and shovels companies were on an absolute tear. We held back, and with good reason, because you started to see some inflationary pressures affect some of their competitors, like Siemens Gamesa in particular, and a few issues that brought Vestas back to our valuation, to our buy level. So I think all those names, everything they've got in common is that we've been patient on getting into them. And we think that looking out for the next 12 to 24 months, you're going to get some PE re-rating and some earnings expansion. And then actually from an ESG perspective, they're actually very good. So GN and Vestas, they're both, Vestas is AAA, GN AA rated. So again, typical of a lot of these European companies that have just got excellent ESG frameworks.
Yeah, fantastic.
Yeah.
Well, I'm just looking at the time now, and it's come to the formal part of the presentation to end, and we've got some Q&A questions appearing, and please keep sending them through, which is great. But I might start off to begin with, which is in terms of the SMID portfolio now, and just focusing on that, where have you found, I guess, most opportunities? Are you looking at more of that mid-cap part of the market, or is it in that small space at the moment?
So the bulk of the portfolio is still in that mid-cap part of the market. So we've still got more than 50% of the portfolio above 15 bill market cap.
Okay.
But we have been, some of those newer positions I was talking about that have come in, are more that sub 15 bill.
Okay.
So 6 months ago, our view was that particularly some of those small cap, they're just way too expensive. So 6 months ago, there was, if you looked at the PE of, say, the MSCI World Small Cap Growth Index, it was very expensive. It was probably about a 10 PE point premium to the broader index. You've seen those names just come off a little bit more, so they're getting a bit more attractive. But there's no question that the ability to invest in some of these mid-cap names, that's where the best relative value is at the moment. But it's also tends to be where we're seeing companies that are getting stronger through COVID. They're actually picking up market share. I mean, I've used the example of Tractor Supply in the past as being a really strong retailer that has been a massive COVID beneficiary, not just from the fact that people are moving more into rural communities in the US, but the fact that a lot of their weaker competitors in the US, they're bleeding market share to Tractor Supply. They picked up 9 million new customers last year, and they kept coming back. So, yeah.
Fantastic. And then one question I've got here, do you think the risk of stagflation is real?
I'm not so much. I'm not that concerned about stagflation. I think the bigger issue that the market isn't factoring is just the extent to which we're going to have prolonged inflation. Maybe not, not huge inflation, but just going to be with us for longer.
Okay.
And that's more coming from what I was talking about before. It's more about this wage inflation that is probably going to be with us for a bit longer. So even if energy prices and commodity prices start to normalise somewhat, it's this wage inflation that it's harder to see that going away anytime soon.
Okay.
Yeah.
And then I've got a question here on responsible investing. So there's one on a specific company. So Ryan's comments are like Electronic Arts, or the game that you just bought, has some games that might be considered, I guess, not games per se, but maybe in the gambling context. So is there any thoughts, or have you got any thoughts around that?
Yeah, we're very aware of that. We're aware that they've got some exposure there. I think, the bulk of their portfolio it's in sports games. So it's like FIFA, Madden football, that sort of thing. So I think, in totality, it's, we think that the portfolio is not necessarily, it's not raising enough of a sort of a social concern for us to look at exiting the stock, but it's definitely something that we keep an eye on. And again, like in the tobacco issue with Couche-Tard, like we always have an awareness of risks that are within every company in the portfolio. And the reality is every company on the planet has air share risks.
Yep.
And anyone who says they don't, they're just not looking hard enough.
Yep.
It's a question of taking a view on the materiality of that risk and making sure that it doesn't get too big, I think. But an EA from a revenue perspective on that issue, that doesn't come close to triggering any revenue threshold that would cause us any great concern at the moment. But again, you definitely watch it.
Yeah, perfect. Well, I think that's another question was just around your discipline around ESG, but I think you've answered that quite well.
Yeah.
I guess another question that's come through from Steve is, what do you see as the biggest mispricing of risk in the markets at the moment?
The biggest mispricing of risk, I think it comes back to what we were talking about earlier, which is it's the more cyclical parts of global equities, in that they are arguably pricing in a possibly heroic GDP outcome next year.
Yeah.
And that's the disconnect to me, because when I come back to, the hobby horse I was on before about China's GDP growth, it's hard to see how that's just going to change. Yep. It's hard to see how that drawdown is just going to go away. It seems like even if it moderates, it still seems unlikely that you're going to get the GDP outcomes in China and emerging markets more generally than what people are currently sort of pricing in. So I think, and so to draw that back to a sector, you've got global industrials, and frankly, a lot of the more cyclical ends of the market is probably where there's the biggest disconnect. In other words, those names have had a huge run, and they're probably somewhat ripe for disappointment.
Yeah, okay. That's good to know. And then the last one I've got here, so any more questions, please do come through. We've got a little bit more time left. Is in terms of the Bell team, what is the biggest topic of debate in terms of financial markets, or what is the team, talking about most?
I think it's earnings sensitivity. It's earnings sensitivity against the backdrop of inflation, supply chain disruption, and that's probably the biggest topic we're talking about now. Particularly supply chain disruption, because that's everywhere. That's affecting a lot of companies. Some a lot worse than others. Clearly, we've got no exposure to autos, but the auto companies had a horrific year. This year it's just been impossible. Semi shortages, right across the board. So I think that's a very disruptive event that has sort of been somewhat different to what we've seen in previous cycles. It's not just about how a packaging company is dealing with rising raw material. It's a bit different to that. So, and it's a bit more unclear as to when it's actually going to mitigate or go away.
Yep.
So I think those are probably some of the bigger things. And then also, and probably the one other thing is just getting our arms around, just more the macro conditions for next year, because there is probably a bit more uncertainty.
Yeah, cool. Well, in the interest of time, Ned, I'd like to thank you for your time this year and spending it with me and the audience as well. This presentation will be emailed to you again. You've got a bunch of names up there from Channel Capital and Bell as well, but if you do have any further questions, please reach out to the people on the page. We will be emailing the presentation in the coming days with a recording as well. So again, thank you all for attending, and we look forward to seeing you hopefully in person next year. Thanks.
Thank you.